As the world seems to have learned how to live with COVID, one of the sectors that seems set to benefit most are airlines. Well, Frank Holmes joins us now. He's the Chief Executive Officer and Chief Investment Officer at US Global Investors and is a partner of Han ETF on the US Global Jets UCITS ETF Exchange Traded Fund. Frank, it's a pleasure. Thanks indeed.
Great to be back with you.
Look, it's been a long time since we've spoken, but I want to talk today about airlines because I think it's a really interesting sector. But I've got to ask the first question. Why, when we see the economy's been trashed by higher interest rates that the central banks are doing, they're squeezing incomes, consumers are under pressure, corporates are finding it difficult to deal with all the debt, but we're talking airlines. Why?
Well, cash flow and revenue. One of the biggest inflationary items as an industry last year were airline tickets.
Right.
They went up 41%. It didn't stop them. The airlines turned positive free cash flow much faster than any analyst in the city or Wall Street had forecasted. And why is that? Shortage of pilots and this huge pent-up demand. So Economics 101 is, if you limit supply and demand is big, prices go up. So airlines have pricing power.
In your presentation, you talk a bit about headwinds and tailwinds. Explain more about what, we've got a slide to bring up just to quickly run through. Explain more about what we're seeing.
Well, it's always good to have a balanced perspective. And we at US Global always like to look at what are the strengths and weaknesses of the past year and what are the opportunities and threats going forward the next 12 months. And that's how we sort of manage our expectations. And what you're seeing here is that there are headwinds and they seem to dominate this negative narrative in the media, but the airlines are outperforming the overall market. They've far outperformed the S&P 500. They've outperformed the London Stock Exchange. So why is that if there's such a negative pent-up demand? Well, in Europe, we have Lufthansa's IT department goes on strike, or you had one problem after the other, and it gets the dominant part, but people still are flying and people want to leave. They want to get into sunnier weather. So in the US, we had Southwest Airlines, which has been the best run airlines in the world. They ran into all these glitch problems. And then you had FAA had technology problems. Didn't matter. People are still booking flights. So we see that, and the pricing power that they have, the cost of flying across the pond is expensive. It doesn't matter.
How do airlines sit in the grand scheme of things against other asset classes?
Well, one of the things of my research in creating jets is a quant-driven approach. So it has the 4 big U.S. airlines, which captures 65% of all travel in America, and also just 4 of them, so they're 40%. But it catches most of the travel across between Europe and the U.S. are those 4 airlines, particularly the 3. And then it has all the international airports. Well, they recalibrate every quarter. And that's the idea, is being able to, who has the strongest revenue and cash flow and who's the least expensive. So it is dynamically readjusting each quarter, which makes it sort of, you say, active, and they call it Smart Beta 2.0. But I think what's really important for investors to realize is that there is an ecosystem of different traders. So trains and trucks trade at 3 times the PE ratio of airplanes. So the GARP investor likes those. And then we have the day trader. The day trader loves the DNA of volatility. And so before you look at this, you can easily see that on a one-day basis, it's a non-event for oil to go up or down 3%, and same with the New York Airlines index. So 3% is nothing. For a day trader, that's huge. And then over 10 days, it's 8%. So they're attracted to that volatility. What we have found is that the biggest reason for the volatility is oil. And what we see is that if oil prices go above their 50-day moving average, the airlines sell off. If oil falls below the 50-day, which it is today, the airlines take off. But what my other research has shown, and I've spent thousands of hours of looking at stocks and then macro forces, is that the airlines is a leading indicator. The GDP is lagging. It's looking out the rearview mirror. This is the car at nighttime with the lights on saying, where's the economy going? The fact that it's rising above the overall market says that all this negative news of rising interest rates, etc., is short-term noise. The other positive part that's happened since 1954 is that 1954, this is a long time ago, that on the third year of a presidential election year, the markets are up. No matter how negative the news, the mathematical probability. So maybe that's what's taking place. It's a strong leading indicator looking 6 months out. It remains bullish.
Yeah. Let me just bring up the next chart because this is interesting. It shows the drop-off that we saw during COVID. I mean, that was a phenomenal decline, and we didn't know where we were going at that point. We have seen this rise, but it seems to have started to crest.
Well, let me explain this. It was remarkable because it came out at the very bottom. The TSA never published this data.
Oh, right, okay.
And so the quants, the macro quant funds, they love this data point because they're looking at the 50-day moving average and the 10-day, is it torquing up or torquing down? Now, prior to COVID, 2.7 million people traveled in America. They cleared. 2 million domestically, 700,000 inbound from Europe and Asia and Latin America, predominantly from Europe. So that fell from 2.7 million down to 90,000 in April the 15th of 2020. And it started to climb. Warren Buffett capitulated. Everyone was getting worried. But the volume started to grow as people said the vaccine's going to come and we're going to get it. So to me, it was starting to take off before the vaccine was created and being distributed. And then as it was being distributed, the airlines kept growing. It's a wonderful leading indicator.
Yeah, interesting. I think this is illustrated by this chart here where we see against the S&P 500 this lift-off that we've got. Is that going to continue? There's got to come a point, I guess, where we reach pre-COVID levels, which I suppose then people start to think, well, we've been there, done that. We got back in the air, we want to do something else. Or do you see
There's a shortage of pilots.
Right, okay, fine. So
And
the effect
to
of that
become
is
a pilot, they came up with new laws and rules and regulations back in 2016, 2017, that a pilot had to have many more years of experience before they could fly commercially people. So that universe of potential pilots, and then we have all these other pilots that are turning 65, they were forced to retire. Well, now they moved it to 67 because they say pilots are much healthier today. And in Japan, they even moved it in higher because there really is a shortage of pilots. So you have a shortage of pilots, you have a shortage of paths to be able to fly, but you have pent-up demand, pricing power.
What about the Asian markets? We're hearing a lot about China is relaxing its COVID rules.
It's very, very important because of just, it is the sort of the wealth of people. So if you have 300 million Americans, it was the highest GDP traveling all over the world, and it gets lost in a sea of 1.4 billion people in China. But what we did see in China was all of a sudden 300 million people were making close to the GDP of the US. And what happened when that happened in China is they started to dominate travel. Tourism was huge in Europe, was dominated by Chinese tourists. They were the biggest inbound coming into America for tourism. That crashed. And just 3 months ago, it really opened up. And we saw the Asian airlines explode on the upside. And now you're seeing Chinese travelers going around the world much more often. That is another big important part. Now, when it comes to the hotels, they're usually third level, 3-star hotels and 2-star. They fill those up quickly. The 5-star and the 4-star, that's dominated by Europeans and Americans.
What about capital expenditure? You mentioned the cost of oil. Of course, airlines have to keep up with technology. They have to keep up with aircraft. It costs a lot to service an aircraft, let alone buy one. What about capital expenditure?
Well, that's a record. And a lot of the new money that's coming in from President Biden is for airports.
Right.
So there's going to be a big resurgence of money going into airports and fast rail going into the airports. And we're talking about billions of dollars. So I think that's very, very positive for job creation, but it's also for dealing with all great economies build infrastructure.
Yeah.
And the Chinese, their whole growth is because they first invested heavily in infrastructure. Now we're seeing that take place in America. That's very positive for the airline industry.
Yeah. One other area I want to talk about is how corporate travel compares to leisure travel, which I guess there is a fairly good, interesting sort of stat to pull out from this as well.
You know, it's interesting you say that because the demographics, prior to COVID, only 11% of the people wanted to work from home. And since then, it's 30%. So this has created a million new business leisure travelers. And that's why JetBlue is taking over Spirit Airlines. So a lot of young people want to say, well, I'll do my writing, I'll do my coding in Spain. I'm going to go to Portugal, I'm going to go to Italy, Sicily. As long as there's good Wi-Fi, I can do all my work from there. And at nighttime, I can walk on the beach. That sort of mindset. That never happened before. The other part is Zoom did sort of help facilitate during COVID, but the business traveler still hasn't exploded, where they would go and buy $10 million worth of airline tickets because they're traveling back and forth. Now that China's open, Europe is open, America's open, it's looking at this year we're going to get pent-up business travel where there's bigger expenditure. That is just a big tailwind. It's another big part of the airlines having pricing power.
One of the things I wanted to talk to you about today was this ETF, and this is the ticker's Jets, and I think we got here a performance. It's taken back to, what's that, January?
This year.
This year. It's been a good 6, 8, 10, 12 weeks, whatever it is. Can the differential continue? What are we looking at here? Again, it's cresting over.
Well, it's not so much really cresting, it's far outperforming. And so why is that? As I'm trying to share with you earlier, is that there's such negative sentiment of rising rates, and earnings going to slow down, and the airlines are saying, no, something else is happening, but it's further out. And the airlines industry has unique constraints in it that they have pricing power. So the rest of the economy can slow down. Doesn't matter the airlines. If you have another 100 million people that want to travel around the world, and there's less number of opportunities to fly, up go the prices.
Yeah. What's in the ETF? What are you covering here? What component parts? Give us this.
The four big airlines try to capture 65% of 40% captures 65% of all air travel. Right. That is between Europe and America, those airlines. The rest are stock picking. So those big four recalibrate every quarter, they rebalance. After that, it's on fundamentals. So who has the strongest revenue per seat for the last quarter or 4 quarters? Who has the strongest cash flow to enterprise value? So there's 5 factors, and what we found is that to mitigate currency volatility as we go global, such as we can own Beijing Airport. You can't own most of the airports in Europe if they're not by the government, they're private equity. And de Gaulle is public. Thailand is public, Beijing is public, so there are, and in Cancun and tourist jurisdictions in Latin America, they're public. They run like private equity. And so what you see, we will turn around and buy 50 basis points of those, but we'll have many more names. So the airlines themselves that carry passengers that have the biggest pricing power, it's a smaller universe of names, but as we go to all these other international smaller airlines, because of the sheer size of it, then we have smaller pieces of investments in them. But it recalibrates every quarter, and we take them out. 20% are kicked out because they're just not, they're not competitive in growing their business models.
So it's a dynamic index which takes opportunity.
Dynamic.
Yeah. Okay, look, we'll leave it there, but thanks indeed for joining us, Frank. It's fascinating.
Wheels up.
Indeed, that's right, yeah. The Jets ETF. That's Frank Holmes, Chief Executive Officer and Chief Investment Officer at US Global Investors, and is a partner of Han ETF on the US Global Jets UCITS ETF. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.